I hope the video is not going to confuse things. I hope it works well. So today, Victor and Luke will be looking at IAS 16, which is property, plant, and equipment. I've made it more practical in the way I've actually picked certain elements into the presentation, which I think will be more valid and more meaningful to you both. Yesterday, the day before yesterday, we looked at borrowing costs, which is IAS 23, and we then went to grants, which is IAS 20. So once we are done with this, hopefully tomorrow we'll look at IAS 40 on investment, and we'll be done with all the elements under non-current assets. Then we can start looking at other standards. I know we have already looked at IAS 36 and IAS 1. Sorry. So what are the objectives of this standard? First, this standard looks at property, plant, and equipment, looks at the equipment, motor vehicles, and all these other things that you have, buildings in the organization. So there are three objectives that we'll be looking at. One is to determine which type of asset should be accounted for as PPE under IAS 16. Not all assets will actually sit under IAS 16 or be guided under IAS 16. You may have investment properties. You have houses that you are actually renting out. Those houses will be regarded as investment properties. Therefore, they will not fit under IAS 16. We need to have these assets that are able to generate value, and that's what we'll be looking at. Secondly, to determine when it is appropriate to use the cost method and the revaluation method for measuring property, plant, and equipment, and subsequent to initial recognition. So when do you use the cost model? When do you go further and use the revaluation model? And when you are using revaluation model, how do you account for what should actually go into the revaluation reserve? Thirdly, we'll be identifying the information needed to calculate depreciation expense in accordance with IAS 16. So those are the three objectives under this particular standard. What is the overview of accounting for PPE? When I look at PPEs, property, plant, and equipment, it's easy for me to memory peg with human life. Before we existed here on Earth, before our existence, so to say, we are not part of the register on planet Earth. Central Statistics Office will not be in any position to account for our existence because we never existed. So there's now birth, growth, deterioration, death in terms of human life or human cycle. So when we look at property, plant, and equipment, the first thing is initial recognition. We'll need to recognize that this particular thing we have is an asset and it is going to fall under IAS 16. But just recognition alone is not enough, Lope and Victor. We'll need to measure it because we'll need to attach a cost to it. So the first thing that we'll look at is initial recognition and measurement. With time, because we're using this asset is generating value in form of revenues. This is a value driver. It's the one that is driving value. So it has its own economic life. And each year that comes, or each year that ends, every year ends, there is value that is actually removed from this particular asset. And that removal of value, or what one would say, that is a component that has helped you. What you're removing from this asset is a component that you believe has helped you in generating those revenues, because you're using matching concept, which states that revenue earned must be matched against expenses incurred in earning it. So depreciation, while you're removing that component, is because that particular cost portion of your asset has contributed to generating revenue. So we're looking at initial recognition and measurement, subsequent measurement, then impairment and recognition. So the asset may still be there, but maybe because of technological advancements, that particular asset may actually be out of market, out of relevance. Therefore, you need to impair it. And finally, derecognition is basically death you are burying. So the scope of IAS 16. First thing that we need to acknowledge is that the property, plant, and equipment are tangible assets. There are things you can touch. Good you can't. Good you just have to believe in. But a proper plant and equipment is something that you're able to touch. And it is held for use in the production or supply of goods or services. It is helping you to generate value, which is revenue. It could be for rental to others or for administrative purposes, and are expected to be used during more than one period. So it is a non-current asset, but it is tangible. So let's look at exceptions to IAS 16. What you should not actually include in your composition of what sits under IAS 16. These are exceptions. And we'll be looking at these exceptions and explaining on why they are exceptions. If you have assets, for example, you have another branch, say in Kasani, and that branch, you want to close it, or you are selling it off. When sitting on your balance sheet, that particular branch will need to sit as a current asset, because your aim is to dispose it within that particular accounting period. At that point, it is not going to be guided by IAS 16. It will be guided by IFRS 5, which is an asset held for sale. But there are also certain rules when you hold an asset for sale. The most logical thing to do is not to continue using it to generate value. It should just be held. If it's a plant, you just close that plant and you continue advertising that you're selling this plant. So if such a thing happens, if you have made a decision that this particular asset is going to be held for sale, then it is not going to be accounted for under IAS 16. It will sit under IFRS 5, meaning that you do not need to depreciate it. I've always told people that the only way you would know that the organization thinks is a going concern, they believe that they are going concern and they will continue operating as a going concern, is when they recognize depreciation. Because then what they are saying that this is a component of value erosion from this. This is a component that we applied to generating this revenue that we are recording. Whenever you find financial statements where there is no depreciation, yet they are assets, yet they are depreciable assets. Maybe let me qualify it in this way. Where they are depreciable assets, yet it hasn't been depreciated. Just know that that particular organization is no longer a going concern, and they believe that's not a going concern because they'll be disposing it off. This is why they are not accounting for depreciation. I sound like a Pentecostal pastor now. Hi, Victor, are you getting me? Look.
Yes, coach, yeah.
Getting you, coach.
Okay, so say, go deeper, go deeper. This is what they're doing, Pentecostal. Go deeper, Papa. Okay. That's the first component. Secondly, it is biological assets related to agricultural activity, which is managed under IAS 41. For example, I'm a livestock farmer or a traditional person that keeps cattle. Even in my asset register, I do not depreciate them. They are all accounted for under IAS 41, which is biological assets. For one with a crocodile farm, we will not actually have it under proper plant and equipment. These are biological assets. So they are exempted from this particular standard. Thirdly, recognition and measurement of exploration and evaluation assets. So if you're doing your explorations, you are also doing some evaluation, any of these assets that are categorized as such and are being used in the area of exploration and evaluation of assets in Zimbabwe or Botswana or Zambia. They should not sit under IAS 16. IAS 16, we are saying these are assets specifically in use to produce and eventually you recognize value from it, from those elements that have been produced, from those units that have been produced by your asset. It's basically for production purposes. So any assets that will sit under exploration and evaluation, please use IFRS 6. Mineral rights and mineral reserves, such as oil, natural gas, and similar non-regenerative resources, say oil. It's not going to sit under IAS 16. Copper is not going to sit under IAS 16. Number 5, land and or buildings classified as investment property. You have even classified them as investment property. They will sit under IAS 40. You may have assets that you list. So these assets, they are not your own. But they are helping you to generate value. These assets, they will sit under IAS 17 leases, which we'll be looking at in the next few days. So we then now go to determining assets. How do we determine these assets? So there are some questions that deserve answers. One is, do all of the assets currently accounted for as fixed assets meet the definition of property, plant, and equipment listed previously? Do you currently account for any assets as fixed assets that are specifically excluded from the scope of IAS 16? So we'll be answering these questions. So if they are excluded under the scope of IAS 16, they will still be fixed assets. They will still sit under non-current assets, but they will not be accounted for under IAS 16. So we start with the first, my passion, biological assets. These are related to agricultural activity, and mineral rights and reserves are outside the scope of IAS 16. So biological assets and mineral rights and reserves are outside the scope of IAS 16. But the standard does apply to property, plant, and equipment used to develop and maintain those assets. So the assets that we are using to maintain our biological assets, those assets, they will be under IAS 16. As long as we're using them to maintain these assets. Initial equipment recognition. In some instances, property, plant, and equipment may be initially recognized using a different method than that described in IAS 16 initially. Then subsequent recognition can actually come and sit under IAS 16. So we then now go to initial recognition and measurement of property, plant, and equipment. The first thing that we'll do is to recognize. So recognition is key. Property, plant, and equipment should be recognized as an asset if and only if. And these are things that we need to look at. What are those criteria that we should use to recognize property, plant, and equipment? Memory peg, how should we recognize a human being? So here first is that we should be able to measure its cost reliably. So whatever equipment we have that we have recognized, we know that it needs to sit on our books or financials, specifically of our balance sheet or what we call statement of financial position. So how is it going to sit there? There must be some cost of some kind. So we should be able to measure the cost reliably. Secondly, this is an asset, it is not a liability at all. So if it is an asset, then what was our intention when we were acquiring this asset is that it is we expect that there was going to be probable economic benefits to flow to the organization. I'm using a term probable from probability. Yes, we believe that there will be economic benefits from it, but it's basically a probability. You may have an asset which you think is going to generate value to you. Economic benefits will flow to you, but you end up having an asset that becomes a liability, that consumes more maintenance costs than it is able to generate value. So here we're saying it is probable that future economic benefits associated with the item will flow to the entity, and the cost of the item can be measured reliably, which I've already mentioned. So which now takes us into measurement, because we have recognized that this asset, one, we are able to measure it reliably. Two, there are some economic benefits. Three, it has its own economic lifespan. Because without economic lifespan, are you aware that you will not be able to depreciate? Hello, Victor? An asset that does not have an economic lifespan cannot be depreciated. Do you agree with me?
Yeah, but yes. Well, what base can you use to?
All you're saying is that I'll use a local term. All you're saying is that it will continue generating economic benefits to you in perpetuity.
Wamuyaya.
Just continue. So you cannot depreciate, and this is why land. If you believe that's going to continue generating value and giving you the economic benefits, you don't depreciate it. So any asset that does not have an economic lifespan will never, ever be depreciated. So under measurement, initially, the proper plant equipment that qualifies for recognition as an asset should be measured at cost. Okay. So, like I said, I have designed these notes. You'll never find them anywhere. I designed these notes for in a more interactive way so that you can interact with them nicely. Safety or environmental? The question that I'm asking, first, items acquired for safety or environmental reasons don't directly increase the economic benefits according to the entity. We know that if you have this safety thing, a fire extinguisher at your office, does it actually increase the economic benefits to according to the economy, to the entity? It doesn't, isn't it? Victor, it doesn't. It's just there idling. But you see why you have it. Yeah. In an event that your assets are threatened, you go and use that particular asset to extinguish fire. But in its strictest sense, that there is no probable economic benefits to that. It's not increasing the economic benefits according to the entity. So the question is, do these get capitalized? Do we still capitalize these assets as under proper plant and equipment? This is the question. Victor, tell me something. And look, there's a question there. Do we still capitalize this type of assets or we expense them?
I think we expense them.
I think if we own them more than, I think if we own them for more than a year, you can capitalize. But if you're using, they are just what do you call them? If they are not reusable, you use it less than a year. and then we spend.
Some of them, like you put it.
So the answer is here.
Okay.
They will be capitalized. The acquisition of proper plant and equipment for safety or environmental reasons, although not directly increasing the future economic benefits of any particular existing item of proper plant and equipment, may be necessary for an entity to obtain the future economic benefits from its other assets. Yes, it is not increasing, but there may be some economic benefits that will flow future. So items of proper plant and equipment acquired for safety or environmental reasons qualify for recognition as assets because they enable an entity to derive future economic benefit from related assets in excess of what could be derived had those items not been acquired. So if you find a question on the safety or environmental assets, that is the leakage there. Now, on major inspections, the question is, can I capitalize the regular major inspections if parts are not replaced? So if you do major inspections where the substantial costs incurred, obviously on major inspections, even if you are not replacing a part, as long as the substantial cost that has been incurred in inspecting these particular assets, the standards allows you to capitalize. But you have to be consistent. What we have seen in most of these organizations, Loco and Victor, is that for those companies that want to manipulate profits, they will look for small expenses. Even when they are not substantial enough and they are not regular, they will take them to, they'll capitalize them so that in the income statement, they're able to show or record some substantial amounts of profits and create a very good profit margin. So we're saying yes. A condition of continuing to operate an item of proper plant and equipment, for example, an aircraft may be performing regular major inspections for faults, regardless of whether parts of the item are replaced. These are three key elements that if you find it in your exam, you may end up with speaking Setswana. So you need to know this. So when each major inspection is performed, its cost is recognized in the carrying amount of the item of proper plant equipment as a replacement if the recognition criteria are satisfied. So it doesn't necessarily mean that you need to replace a part, a spare part, or a part of some kind of major part for you to recognize. Even just major inspections, as long as the substantial cost and it is actually passing the criteria of how you recognize that particular item, you then now can actually capitalize it. Self-constructed assets. You can buy a one-off asset, or you can construct an asset. So is the accounting for self-constructed assets significantly different from the accounting for acquired assets? No, it is the same. So the cost of a self-constructed asset is determined using the same principles as for an acquired asset. Are we there?
Yeah. I hear.
So then now we go to subsequent measurement of proper plant and equipment. So after you have recognized an asset, you can then choose either to use the cost model or the revaluation model as your accounting policy. So management should apply that policy to an entire class of proper plant and equipment. Do not cherry pick, because as you cherry pick, then you're actually creating chaos or you're manufacturing confusion. In short, you may also be accused of manipulating financial data or outcome. So the method used to measure the gross carrying amount of each class of PPE should be disclosed. You need to disclose. So measure reliably, subsequent measurement of PPE or proper plant and equipment. You need to measure them reliably. In order to use the revaluation model, the fair value of the proper plant and equipment must be able to be measured reliably. You should be able to measure the fair value in a less contentious manner. Evidence by appraisal, sometimes even just using your eyes and appraising or desk, or what we call ground truthing, where you go on the ground, you observe, you do your evidence check and all that. So a reliable measure usually is determined from market-based evidence by appraisal that is normally undertaken by professionally qualified valuation experts. Other methods. Suppose there is no market-based evidence. I'll give this example. We have one of our power stations that is just on your border, Zambia, Zimbabwe. This power station, I think it was built around 1937 or maybe before that, the Victoria Falls power station. Imagine the equipment that is in that particular power station. I'm sure that most of the parts, they are not being produced today. They are not being manufactured today. So how do you get your fair value? You cannot use market-based. So they're saying if there is no market-based evidence of fair value, because of the specialized nature of the item, and the item is rarely sold, and maybe it's even out of production, management may use other methods to estimate fair value. They can also use an alternative for a modern part or equipment that is found in these newer power stations. They can use that as a reference point to determine the fair value. Revalue asset class. When an item of property, plant, and equipment is revalued, the entire class to which that asset belongs shall be revalued to. You cannot be selective. You cannot use segregation or discrimination. You cannot discriminate other assets which are within the same class. They all need to be revalued then. It's logical. Revalue simultaneously. Yes? Victor, I can't hear you.
Yes, coach. I didn't say anything.
Oh, okay. Okay, thank you. So revalue simultaneously, revaluing similar assets simultaneously avoids selective revaluation and the potential misleading financial statements. I've already mentioned this. Details on the revalued method. The frequency. So frequency of revaluation, the frequency of revaluation depends upon the changes in fair values of the items being revalued. So the changes in fair values can actually trigger your organization to revalue the assets. But where you have your fair value of a revalued asset differing substantially substantially from its carrying amount. There's some materiality there. Then further evaluation is required because at any given time, the carrying amount and the revalued amount, the fair value must be almost close. Yes, it cannot be exact, but there should be some levels of tolerance. Some items experience significant and volatile changes in fair value that would also necessitate annual revaluation. So such frequent revaluations are necessary for items only in significant changes in fair value, which I've already mentioned. Must be substantial, must be very material. Increase in carrying amount. So I think if an asset's carrying amount is increased as a result of a revaluation, what do? We know that to balance it, that component, the incremental or delta, as they would call it, a delta component, which is just an incremental component, must be credited to the equity, to equity. So credit equity, that is what you do. So however, because that equity, a component is coming from your profit and loss. So I'm saying, however, the increase shall be recognized in profit or loss to the extent that it reverses a revaluation decrease of the same asset previously recognized in profit or loss. So this is why you have it there under comprehensive income or through profit or loss. That I know we know. So let's look at this question. Example 1, revaluation increase. It reads, Goswami bought an item of property, plant, and equipment for 80 million on 1st January 2012. The asset had 0 residual value and was to be depreciated over its estimated useful life of 20 years. On 1st January 2015, the asset was revalued to its fair value of 95 million. Calculate the amounts to be shown in the financial statement of Goswami for the year ended 31st December 2015. I hope it doesn't get confused. I want to get the whiteboard. Yes. Okay. Look, you see that online classes are even far much better than physical ones, eh? If they are well delivered.
Yes, yeah. You're right.
So now here, what is going to happen is that there will be 3 things. That first, at recognition, you are looking at, so we are saying we have cost model. Then we have revaluation model. because we are revaluing. Then we have the revaluation reserve. Whatever comes from these two, ultimately, the difference goes into the revaluation reserve. Oh, should have written here, revaluation. My electronic handwriting is not that good. Can bear with me. Others would even call this first column as the historic, but it's basically cost model. So we go back to the question. Here what are we told? On 1st January, we recorded it's 80 million in 2012. So this was the initial recognition. What was the cost? 80 million. Let me just do like this so that I put the million this side. Or just 1,000. So we have 80. What was the lifespan?
20 years.
20 years. So the lifespan was 20 years, meaning that per year, what was the depreciation per year?
4 million. 4 million.
4 million, isn't it? So from 1st January to from 1st January 2012 to 1st January 2015, how many years passed?
3 years.
3 years. So we have depreciation here, which will be which will be 80 divided by 20 times 3 years. This is on the 31st December 2014, right?
Yeah.
Which gives us 12,000?
Yes.
Or 12 million as depreciation. At this point, we haven't yet revalued the assets. So we have 68,000 here. So on 1st January, as you wake up early in the morning, on 1st January 2015, you have been told that this asset has been revalued to 95,000 or 95 million. The clue, let me explain this. The number of years originally that were coming from here, the 20 years economic lifespan, remains as is. So as you revalue, always know that the 20 years, you don't revalue the years. So all you do, otherwise, if you revalue the years, then there's just a change of estimates or whatever it is, but you don't revalue the years. So you have already used 3 years So the only years that the lifespan of this particular asset is now 17 years. It is remaining 17 years. Please get this right because it is important. So 68 might, so your assets have gone to 95. The first half of the balance sheet has increased by the difference. The difference between these two is what?
27.
27, meaning that what will go into your revaluation will be 27,000 or 27 million. Victor, does it make sense? Otherwise, you're not going to balance your balance sheet.
Yeah.
So to balance it, because we have increased by 27,000 on the first half of the balance sheet, meaning that under revaluation, under equity, you also need to credit equity so that you balance it by that same amount. On the 31st December, (2015), here under the cost model, if you are using this cost model, meaning that you will still have a 4,000 there because you're using cost model. You don't add anything because it doesn't mean a thing. You're just showing this asset. If it was cost model based on cost, would have depreciated a 4,000 from the 68,000 that we have, and you end there, please. Because what is going to sit in your balance sheet, your statement of financial position, will be the revalued amounts. So this side now, where you have this 95, remember that your thing, you have revalued to 95. But in revaluing it to 95,000 or 95 million, sorry, the lifespan that you are now using as a revalued lifespan is 17 years for your DIP, because this is basically your depreciation. So what is it? How much you get there?
5,588,235. So it's
5,588.
Yeah.
0.25, huh?
And 224.
Okay. Or I'll round it off like this. So the difference, 95 minus 5,588, because that is what is going to sit in your balance sheet. In your, yeah.
89,412.
89,412.
412.
What will be in your evaluation? Because you are supposed to have 4,000. But after revaluing, the depreciation charge went to 5,508. So you need to find the difference between these two. What's the difference? You don't need a calculator, I think.
1,588.
So how much do you get there down?
21412.
How much?
21412.
412.
412.
412. Point, I'm sure. So it will be 21141, isn't it?
No. 142.
42.
There's no one. 412.
Look, is it 20,000? 1,588.
No, it's 27.
Less
Oh,
4,500.
sorry.
It's 25,412.
Yeah, 25,412.
25,412.
Taken the 5,000.
So you're taking it's 5,000. Yeah. Coach,
it's how much? So
25.
I remove this. Okay.
Yes, remove that. 25,412.
Okay, let me just reduce. Wait, I'm still class. I don't know Chinyanja. I'm in class, please. I'm using it. Later. No.
In trouble.
Big problems.
The generation of gadgets. They would want your phone, your laptop.
It's rough. I can't see the pen that I'm using. Let me go this side. Okay. Have it now.
25.
25.
412.
4, 1, 25, oh sorry, 25, 4, 1, 2.
4, 2. Yes.
Something like this.
Yeah.
Okay, so let me just change the ink. So in terms of accounting, this amount here, so in terms of accounting, this amount here will sit under PPE. I don't know what's happening, I'm failing to write. So in the balance sheet, it will sit under PPE, that amount. Similarly,
the 25.
The 25, no, not under PPE, under what? Equity, sorry. Revaluation reserve. So under revaluation reserve, it's already there. So this is where it's going to sit. This 89 is going to sit under PPE. Then this depreciation here will be in the profit and loss account, P&L. Even this 27, even this 27 will sit under P&L. That is how you complete your journal. So this cost model is basically your historical cost model. So you decide whether you're using cost model or revaluation model of a policy. Does it make sense up to this level?
Yeah, it makes sense.
Yes, it does.
The only figure that I'm thinking, 27,000. You say the 27,000 goes to expenses. It goes to P&L. that figure.
It goes to P&L down there as a gain.
Or as a gain, okay.
It's basically a gain. Remember that you had 68, you have now 95. This is the 27 that goes into your equity down there, right? To balance it up before you start depreciating it. But where is it coming from? It is coming from your profit and loss, from your comprehensive income as a gain.
Yeah, I got it.
Okay. So decrease in carrying amount. We have looked at increase in carrying amount. Now we go to decrease. So, if an asset's carrying amount is decreased as a result of a revaluation, the decrease should be recognized in profit or loss. Same thing that will happen, you're going to debit equity directly, and a component of it will certainly find itself in your profit and loss. So what I want you to do, look at this question. I'll give you about maybe 6 minutes to work on this question. It's the same concept. Let me just mute. I'm sure you have managed to detect that there were 2 revaluations done in the space of about a year or so.
Yes.
Okay, so okay, let me just get the whiteboard. So we have the historical cost here. We have the revaluation model. Then we have the revaluation reserve. I'll just call it RR. In all these, we have the dollars, the kwacha, whatever. The thousands. Okay. So we start with the cost. So the cost, it was done when? When did we buy this? Or when did they buy?
On the 1st of January 2018.
20?
18.
13?
Yes. On the 1st of January 2018.
Okay. So what was the cost?
12,000. 12 million.
Okay, so we'll put 12,000 there. Then we had the accumulated depreciation.
Yes.
For how many years?
For 10 years. So for
Okay,
2
so
years.
we have 12,000 or 12 million divided by 10 years times how many years accumulated?
2 years.
Yes.
Giving us
2.4.
So how much is the total, the carrying amount? The carrying value?
0.6.
9,600.
9,600. At this date, when was that? When was that? It was on 31st what?
31st December
2014. At this date, we also revalued, isn't it?
Yes.
We revalued on the 31st December 2015.
On the first, which is basically about the same time. So we are saying,
wasn't it 31st?
Yeah, maybe we say first.
1st of January.
I'm saying the revaluation wasn't it 31st December 2015.
It happened when?
Should be 31st December 2015.
The first revaluation, let me just check.
No, the first happened.
It's
it
1st of January.
It was still on the 31st December.
December, yes.
Yeah, 31st December 2014.
Okay, all right.
So the dates here were okay, which was 14,000 or 14 million. Okay. So then we had depreciation because it was 2 years that actually had passed. So we are saying the depreciation on historical what was 1,200. So depreciation there. This is on the 31st, 0.12, 0.15, which is 1,200. So under historical, if we're using the historical, this amount would be how much? 400? 84, I think.
400. Yes, 8400.
In terms of the revalued, we had 14,000.
14,000 by 8.
Yes, by
now
8.
8 years, right? 1,750.
1,750. The difference to our revaluation reserve would be here first would have a difference of how much? Here we have a difference of 4,400.
4,400.
Then here we have a difference of 550.
Yes. That gives us a reserve of 3,850.
3,850.
850. And the carrying amount of the evaluation of 12,250.
Of 12,000. 250.
Yes. 12,250.
12,250. Okay. I'll just do this. Then I cancel this 0 here.
Then on the same date, it was revalued. But now
On the same date, huh?
Yes.
Okay, so it was revalued to how much?
So is it 8,000? 8 million.
8,000.
Okay, so meaning that there was an impairment on this one. There was an impairment on historical. There was an impairment of 400. It wasn't depreciation, it was an impairment. Then we know that what sat in on our financials was 8 million, right? So meaning that if under revaluation model, there was an impairment as well. What is the difference here?
For 250.
For 250. Which would be like this. So 400, 250 minus 400, how much do you get on impairment? Because that would be your net impairment.
3850.
38.
That's all.
So
Yeah,
it will be like this, meaning that there's nothing that will go into the revaluation model, into the revaluation reserve. This is how it will fit. You have seen, right? So the double entry there is known. We know that the 14,000 will sit under 14 million will sit under property, plant, and equipment. Then we'll have all these impairments and depreciation. The depreciation the other side. Okay, is it okay?
Yeah, it's okay.
So it's just to follow it nicely, the way it flows. But one thing that you just mostly, learners, especially in the exam, they have a problem with this. They always want to take it back to 10 years. You don't take it back to 10 years. You deduct whatever years that have already been used or consumed. Okay. So then now we go to depreciation of property, plant, and equipment. We had already talked about depreciation. Obviously, it is a requirement. And in the exam, they will not give you quite other types of depreciation. There are quite a number of them. Some of digits, some would use production, some would be accelerated and all that. But here we have straight line and reducing balance. Don't expect anything beyond that. On depreciation, I know you can miss it. These are concepts that we all know. Starts when the asset is ready for its intended use and not from when it starts to be used. So it doesn't look at when it starts to be used. It actually looks at when it the asset was ready to be used. That is when you start computing depreciation. Mm-hmm. So any change in estimate is applied prospectively by applying the new estimate to the carrying value of the PPE at the date of change. So that is not. So let's look at change in estimate. It's possible that there can be some changes in estimate, and we need to track these changes. The question or the example reads, Gondwe bought an item. Maybe just take a screenshot so that you can see it on your phone as we go to the whiteboard. You manage?
Yeah.
Done.
Mm-hmm. So here we're saying Gondwe bought an item of property, plant, and equipment for 25 million on 1st January 2012. On 31st December 2014, the asset remaining life was estimated as 5 years. So there's a difference here. This was bought in 2012 on 1st January. So there were only about 3 years, isn't it? 3 years.
Mm-hmm.
So initially, based on the economic lifespan that was computed, it should have actually gone to just about 7 years remaining life, but we had 5 years. So there's a change in estimate. Calculate the amount to be shown in the financial statement of Gondwe for the year ended at 1st December 2015. So let's do it. So here is just change of estimate. So we'll start. Wacha is $2. What was the cost?
25.
25 million.
So 1.112. 25 million, 25,000. Mm-hmm. The accumulated depreciation for the 3 years. Just give me the accumulated depreciation.
Right, that will be 7.5.
Because it's 2.5 times the
times 3. Yes.
Which is 7,500. Mm-hmm. Giving us how much as carrying value?
17,500.
17,500. This is on 31st, 0.12 December, 0.14. Mm-hmm. Then when was the thing changed in terms of the period?
1st Jan 2015.
Okay. So meaning that the depreciation here on 31st, 1.2, 0.14, or 0.15, sorry. What would be the depreciation?
It's now changed to 5, right?
Yes, so to be 17
Yeah.
13,500 by
500
number.
divided by 5.
Divided by 5.
How much do you get?
3,500.
3.5.
3,500. Which gives us 14,000 or 14 million. So this one will go under property, plant and equipment. In the balance sheet or statement of financial position. Then what will go in the statement of profit, loss or other comprehensive income will be this 3,500, that's depreciation. Okay. Is it okay?
Yeah.
Okay, so on impairment and the derecognition of property, plant and equipment, I think I did actually, we did look at a question on impairment. So in general, an impairment loss should be recognized whenever the recoverable amount of an asset is less than its carrying amount. So whenever the recoverable amount of an asset is less than the carrying amount, then you need to impair and you need to show that impairment. So management is required to calculate an asset's recoverable amount and compare it to its carrying amount whenever there are indications that an impairment has taken place. And this is why we normally look at IAS 36, and we did look at IAS 36. I don't know if it was IAS 36 or IAS 38 that we looked at, but we did look at one standard that looks at impairments, which is basically IAS 36. Derecognition, now the asset is almost being rendered irrelevant. We have to derecognize it. So the carrying amount of an item should be derecognized upon disposal of the asset. So the moment we dispose the asset, we derecognize it. In short, we are removing it from our balance sheet, from our financials, from our asset register. And whenever we see that this particular asset there is no promise whatsoever that there will be any future economic benefits to flow, so that we can use it as an opportunity to derecognize it and dispose it. On recognizing, whenever there are gains or losses, should be recognized when the asset is derecognized. So as we derecognize this asset, as long as there are gains or losses to that effect, we should actually be able to recognize them. And gains should not be classified as revenue, they'll sit down there. On the determination, impairment and derecognition, so determining as well, how do you determine these gains and losses? So gains or losses are determined as the difference between the net disposal proceeds, if any, and the carrying amount of an asset. This, we have looked at it in many ways, and especially when we're looking at the group cash flows. So Victor and Luke, we end here. But as usual, you need to check out. So I don't know who's going to start first.
I can start. Yeah, it was recapping for me. Yeah, I think I hadn't forgotten the basics, so it was enlightening because it was just a recapping of the things
We can clearly hear you. Just speak a bit louder. I'm
saying it was recapping for me, a recapping of the basics that I learned some years ago.
Mhm.
So it was interesting.
Mm. Sure, sure. Next.
Thank you, Coach. It was clear and I could follow, and the most important thing is I got the basics. And I'm sure if I get a question in practice, I'll be on the right track.
Sure.
Thank you.
Thanks so much. Guys, there's no way you're going to fail this exam. Victor, do you think you'll fail this exam, sure?
I won't fail.
No, please, you shouldn't. There's no way. You'll be the first ones that have taught financial reporting, advanced financial reporting, and failing. So you break my record, which is okay. Okay, bye-bye. See you tomorrow. Thank you so much.
Okay,
All
cheers.
right,
Good night.
thank you. See you tomorrow. Cheers, good look.
Huh?
Good night.
Good night. Good night.